What's happening, everybody? How you doing? Welcome to the exam breakdown today. Pop my headphones on so I can hear myself. It is March 5th, 2025. What's up? It's Wednesday, and today, Wednesdays, we do the Mortgage Loan Originator's Licensing Examination to help those loan officers about to get their licenses pass this examination, which can be a bit of a challenge. I'm fully aware of that. These real estate exams, these mortgage exams can be tough. And so my job here of this channel is to help sort of get you through it, to figure out what to do, what you're doing wrong, and give you some suggestions. Now, these suggestions are targeted after like 25 plus years of me teaching people in all kinds of real estate stuff. Before that, I was an note taker in high school and help people in grade school. And I like to learn and I like to disseminate that information the best I can to help people understand maybe what they should know, what they should not know, what they should focus on. So my job is to help. Honest to goodness, just want to be a helpful person. I've trained tens of thousands of folks over the years, helped lots and lots and lots, countless people pass their real estate examinations, their mortgage licensing examinations. I'm licensed in all kinds of states to do mortgage loan originator training and all this other stuff, but that's not why I'm here. I'm here to just help out and see if I can help you get through it. Now, we do have some really cool stuff on the horizon about to get dropped on y'all to give you more of an advantage a lot more quickly. I am noticing a lot of my students are taking some time. Now, take your time. Take all the time that you need. My job is to help you forget about some of the things that you don't need to know and just focus on what you do. Now, I don't have copies of your examinations sitting on my table. However, my targeting systems are pretty keyed in. I've been a subject matter developer forever on these types of content and just personal experience and all kinds of stuff. Pretty good at taking examinations myself. And so I take all of that information and I kind of put it together and understand after years of testing with actual students and figuring things out, I can look at documentation and try to figure out what they're going to potentially ask you, what topics, what types of ways they might ask you questions. And what I find and what my students find, and if you read the comments on our channel, typically you're going to find that people are passing and they're kind of consuming what we tell them. And we're seeing a lot of success. So don't take my word for it. Look at the comments, leave your own comments if you can. Again, this is I call this a crack commando team of misfits. This isn't some huge operation, man. We are just doing stuff. We're working at it. Now, obviously this is a YouTube channel. So, our in terms of like revenue producers, we're putting a lot of content out there just to get to know you folks. And so, if we may flub here and there, put something out, I make a mistake. Like I just qualified these questions as quickly as I could, went through them and kind of like found a mistake. And so if there's an inconsistency, if there's a mistake, hey, take it easy. That's what I'm saying, man. This is like hardcore. This is a lot of work. But, I do apologize. Most of the time we are very freaking accurate, but sometimes we make a few mistakes. Not that often, though. I'm telling you, not that often for people to really shake their finger at me. But if you find something, you can shake your finger at me. I don't take it personally. I have a pretty thick skin, so I don't really care. But, again, look at the comments. If you have comments on your own, go ahead and put them in. Let us know what you're looking to learn. Let us know how we can help you. I am absolutely happy to do that. And we've made lots of videos now with students asking me questions all over the country about specific things, and we're happy to apply it. So whatever we can do to help you pass, we will do. If you haven't subscribed, please consider subscribing and check us out. We're also offering a free practice exam, nothing for the mortgage originators yet, but we're building something for you guys to be able to just grab some free exam questions and some flashcards, for your email address, basically. And you'll find all of that information in the link below. So just if you're doing all that stuff, hit that up, check that out. Without further ado, what I like to do here during these exam breakdowns is go through some questions, try to figure out some topics that I think are relevant and important, try to eliminate the things that I don't think are important, and then kind of get you going. So this is a brief sort of, let's go through some questions. I'm going to go through a couple of questions here for the mortgage originators today. And what I want to work on, the first question, let's just jump right in. And I'm just looking over my shoulder view. Don't mind really quickly. I just want to make sure that everything's streaming properly. Looks like it is. Sweet, sweet. All right, here we go. So question number 1, what is the purpose of the secondary mortgage market? Letter A, to provide borrowers with low credit scores the ability to refinance their mortgage. Letter B, to allow lenders to sell loans, freeing up capital to issue new mortgages. Letter C, to prevent homeowners buy a second property. Letter D, to protect mortgage lenders from potential loan defaults. So the question is what is the purpose of the secondary market? Now, sometimes what they could do, if I were writing questions, I might try to say all of the following are, purposes of the secondary mortgage market, except, which of the following is a thing. So, again, they could frame these in different ways. What is the purpose is what they're asking here. What is the purpose of the secondary mortgage market? And the answer is, let's get to it and then we'll talk about it, is letter B, is to allow lenders to sell loans, freeing up capital to issue new mortgages. Now, some students have picked to protect mortgage lenders from potential loan defaults. And if you were to look at it in terms, one could argue, but really what letter D is saying here is talking about insurance, mortgage insurance of some kind. And so really that's what the mortgage insurance market is for. So the MI markets is what you're going to find there. I'm just jumping out of your way. I'm going to write MI here. Help homeowners buy second properties. That's just like totally wrong. To provide borrowers with a low credit scores the ability to refinance their mortgage. Well, if you have lower credit scores, there are programs, but the secondary market does not deal directly with consumers. So there's no consumer direct contact. So really, it's to provide borrowers with, so if we're providing the borrower with anything, the secondary market isn't doing that. That's the lending. That's the primary mortgage market. So we have letter B, to allow lenders to sell loans, freeing up capital to issue new mortgages. So it's a way to recapitalize the marketplace. And I just kind of put some notes together. A couple of other things that the secondary market does that you ought to know for exam purposes. I would say number one, liquidity. It creates liquidity in the primary markets. So I'm just going to write it creates liquidity by allowing mortgage loan originators, banks, and other lenders to sell mortgages that they have issued, freeing up capital to make additional loans. Without this market, lenders would have their capital tied up for the full 15 to 30-year term. So think about that. If you're a lender and you're loaning out money, I've got buddies that lend out private money, and when they do, they don't want to hold this paper for 15 to 30 years. They would like to make some loans, make some money from the fees and the charges associated with origination of loans, origination fees, and application fees and processing fees, etc. And then, hey, if I can make a loan based off of what somebody else is willing to buy, even better. So, when we build something and we have a market that's already ready, willing, and able to buy this thing, that's what the secondary market is. Secondary market puts out guidelines. These guidelines establish rules and regulations of what this secondary player is looking to purchase. And they're like, hey, look, first, play right there. If you make a loan like this based off of what we tell you is risky or safe, and you make it based off of that, you can sell it to us. As long as you're playing in the secondary market, we'll buy it. We'll give you your money back. So if you loan out $100,000 based off of what we're looking to buy, we'll buy that thing. And then we'll give you your $100,000 back-ish, and we will, we'll let you charge fees for all of that stuff, and you have to service the loans and everything else. So those are some of the reasons for secondary mortgage market. I'm just going to give you a few more notes on this just so you understand it. It helps with risk distribution. That's a big one. It sort of mitigates risk in the primary market by offloading some of the risk on the paper of the bank. So the bank is holding these long non-callable assets on their books. What if the market turns? What if rates go up? What if rates go down? All this stuff. So these things become risky. And as things become risky, what if there's like a period where mass unemployment is about to take place and so on and so forth? So you're going to start seeing risk, and parts of the secondary market help with this risk aversion strategy. Standardization, it creates standardized rules, regulations, guidelines, risk understanding, etc. When you have standardization and you have something called securitization, then you have something that's valuable to invest in. Interest rate stability. By connecting local housing markets to global capital markets, it helps to stabilize mortgage interest rates and reduce regional disparities. Accessibility and investment opportunities is another big one. So those are some of the reasons why we have a secondary mortgage market. And again, all of those logically you should understand. The secondary mortgage market buys loans off of the primary mortgage market, and then they cut them up into slices and create mortgage-backed securities and sell them off globally. The next question. Question number 2. For a VA loan, what document is issued to inform the borrower and lender of the appraised value of the property? Letter A, the appraisal report. Letter B, comparative market analysis. Letter C, notice of value. Letter D, assessment notice. So the question is asking for a VA loan. And for my loan originator soon-to-be's, they're going to ask you questions about VA loans. You're going to want to know a little bit about VA loans, FHA loans, and USDA loans in the government sector. You're going to need to know conventional loans, and you're going to need to know inside of conventional loans, conforming loans, and non-conforming loans. So you're going to see that categorization of what you need to know here. So you need to know a little bit about them. And for VA loans, you need to know some of the basic things. This is one of those basic things. So what document is issued to inform the borrower and lender of the appraised value? And the answer is letter C, the notice of value. So an NOV is something that is issued for an appraisal. So the appraisal is done on the property, then there's a notice of value. The notice of value is the document that is issued to inform the borrower and the lender of the appraised value of the property. So when we're dealing with VA loans, then the appraiser is submitting the NOV. And the NOV is the document that we need to know by namesake that handles that when we're dealing with a VA loan only, okay? Notice of value, VA loan. You want to definitely know that. And other little things that you want to know about the VA loan, you want to learn about like the total debt, 41% total debt. You want to know about the entitlement, the eligibility piece for the VA loan, and understanding that it could be 100% financing. You want to understand that the eligibility can get restored if they sell the house, then they can get to buy another house. You want to understand what funding fees are and what's the maximum origination fee that you can make on a VA loan. All of those little pieces, follow this video again as it's posted, and you'll just look those pieces up and you should be good to go when it comes to VA loans. You don't have to go too deep and too wide, but you do need to know a bit about them and the qualification. That's going to be helpful. All right, so let's do the next one. All right, question number 3. What are the 4 essential elements of a promissory note? Letter A, property description, loan term, APR, and signature. Letter B, loan amount, interest rate, repayment terms, and borrower's signature. Letter C, credit score, down payment, collateral, and insurance requirements. Letter D, mortgage insurance, lender fees, prepayment penalties, and credit history. What are the 4 essential elements of a promissory note? And the answer? Letter B, the loan amount, the interest rate, repayment terms, and the borrower's signature. So there are 2 documents that we have when we are borrowing money. Document number 1 that we have, I'll just sort of write up here for you. Document number 1 is something called a promissory note, and this is dealing with financing, aka getting a mortgage. We have the promissory note. And the other document that we have is the actual document called the mortgage. Okay? So the mortgage is evidence of a lien. The promissory note is the promise to repay, and this is private between the lender and the borrower. The mortgage is a document that's recorded into public records as evidence that there is a lien or some sort of obligation on the property. Remember, lien is a type of encumbrance. So a mortgage is a scenario. Now, for mortgages, you definitely want to know a little bit about the mortgages, a couple of the covenants inside of a mortgage, like acceleration clause, alienation clause, due on sale clause, estoppel. All of these different things are going to show up inside of the mortgage document itself. You're taking a mortgage test, so they're going to want you to know a little bit about that instrument. The promissory note is a document that the borrower and the lender enter into, and it's something of importance when it comes down to borrowing. And the pieces that are the most important pieces inside of a promissory note are the loan amount, the interest rate, what are the repayment terms, and the borrower is signing this sucker. And if the borrower signs it, then basically it can be transferred because the borrower is promising to do it. Now, the reality of all of these documents is they can be assumed and assigned by other investors. So Bank of America makes a loan and then they transfer it to the secondary market. Some other investor now owns that obligation, so they can assign and reassign these debt obligations in the future. And again, it cuts down on that risk factor for lenders holding pieces of paper for 15 to 30 years. Next question. Question number 4. Which of the following is true about USDA loans? Letter A, they require a minimum of 3% down payment. Letter B, they are only available to first-time homebuyers buying in rural areas. Letter C, they have a 0% or $0 down payment requirement. Letter D, they require private mortgage insurance. So the question is, tell me a little bit about the following truth about the USDA loans, U.S. Department of Agriculture. And the answer, boom. They have $0 down payment requirements. So with USDA, there's a couple of things that you want to know. They are not just available to first-time homebuyers. They're available to refinance activities. Really, one of the operative phrases here are underserved communities. So rural areas are one of the prime targets of the USDA. Now, this is interesting about the USDA that you probably might want to know for your exam. The USDA is the only department agency that can originate a loan internally. The USDA could originate these loans themselves. So to get an FHA loan or VA loan, you have to go to an approved lender to be able to offer those programs. And for a USDA, if a bank cannot serve a community, and there's parts of the United States that are underserved by by lending institutions, well, then the USDA can make loans directly and can originate loans. Now, there's several little pieces that you ought to know about the USDA. Nothing too much, but the way the USDA, for number one, with down payment, it's 0% down. There is an insurance fee, and you do want to check the insurance fee in your books that you're studying this material from. So you might want to know those fees, and how they qualify an applicant. It's a little bit unique and different than the other traditional ways. So they aren't looking to debt to income ratios. They're looking for area's median income, and you cannot make 115% more than the area's median income. So it's really targeting folks that don't make too much money to be able to pay their, for these. It's to channel into those underserved communities. So you want to know a little bit about the qualification of USDA loans, how they work, the area median income, the AMI, and a little bit about down payments. We just kind of covered everything that you really need to know. I wouldn't worry about it too much more than what you just learned here. The next question. Susan applies for a conventional mortgage with a DTI ratio of 46% and a 10% down payment. The lender denies her loan. Which of the following is the most likely reason for the denial? Letter A. Conventional loans typically require a maximum back end of DTI of 43%. Letter B, because she is only making a 10% down payment, the addition of PMI will make her DTI too high. Letter C, conventional loans require a minimum down payment of 20% to qualify. Letter D, all of the above. And the answer? Letter A is the conventional loans typically require a maximum back end DTI of 43%. Now, let me get clear about something here. This is an interesting question, in my opinion. I didn't write it. One of the reasons why I think it's interesting is because in reality, now some of y'all, you're all new getting into the mortgage loan origination business, and say, I'm going to tell you that a 46% back end ratio is fine under certain situations. Under other situations, it exceeds what most lenders are willing to go into or what the secondary market might purchase. If you remember in your books as you're studying, you might learn about something called the ability to repay rule, the ATR rule. And what is a qualified mortgage? Now, a QM, a qualified mortgage, typically will have a DTI, the back end, the debt to income ratio. Look those up. You want to learn how to do those. The debt to income ratio cannot exceed 43%. Typically. Now, why this question is interesting is because if you're kind of in the know, then I know that you can probably get a qualification for 46% back end under certain conditions. They call these conditions mitigating circumstances. So in other words, think of a mitigating circumstance like, okay, yeah, I have a 46% back end, but I have, I don't know, $500,000 cash in the bank and liquidity. So the lender has lots of liquid assets, stable employment history, et cetera, and let's say really high credit scores. So we have three compensating factors that would allow an underwriter to be more comfortable with allowing a 46% back end into the loan pool. Seems like risky, but we have offset that risk with other mitigating factors, compensating factors, right? Boom, we got good stuff. If you don't have that and you're putting down a lower down payment, well, then there is a little bit of truth that's going on here. If you're looking at conventional lending, then there could be a PMI issue in which the PMI factored into the payment could blow this completely out, and therefore now the ratios are no longer in line. That's complicated. This is asking us which of the following is the most likely, right? Like that's the trigger phrase there. Why do they get denied? The most likely reason is that the back end ratio is out of whack, and they're putting a lower down payment here, 10%, which makes it riskier. So again, we don't have anything more to go off of on this question. We only have what we have. And a lot of times what students will do is they'll fill in more information than the question gives them. And that's like a problem that you see. It's a pervasive problem. And so you just have to go with what you're given in that case. And if you are going with what you're given, then I would say A is the strongest possible answer. And that's why A is the correct answer. All right, next question. What does the acronym SAFE in the SAFE Act stand for? Letter A, Secure and Fair Enforcement Act. Letter B, Secure and Federal Enforcement Act. Letter C, State and Federal Enforcement Act. Letter D, Safe and Fair Examination Act. What does the SAFE Act mean or stand for? And the answer? Letter A, Secure and Fair Enforcement Act. So it's the Mortgage Licensing Act. This is the reason why everybody that's taking this, watching this content on YouTube and taking courses, the 20-hour course, and any state-specific hours, this is the reason why you're doing all of that. You're doing that because you are a state, you're looking to get state licensed or to affiliate with a state licensed entity. And if you're a state licensed entity, a mortgage loan originator, then you have to take 20 hours of education and you have to take any state-specific hours, plus you have to take and pass an examination with a 75% or better. So the reality here is the SAFE Act is the reason why you're here. And you also want to know the penalty for violating the SAFE Act as well. So the SAFE Act is why we are here, why you're learning, why you're practicing for an examination. And so this is something you want to know. Definitely, you're taking a loan originator's examination, so I would suspect that you need to know what SAFE stands for. The Secure and Fair Enforcement Act for mortgage licensing. And question number 7. What does the abbreviation GLBA stand for? Lots of acronyms, as you know, in this exam. Or initialisms. Letter A, General Liability Banking Act. Letter B, Graham-Leach-Bliley Act. Letter C, Government Loan and Banking Act. Letter D, Guaranteed Lending and Borrowing Act. And the answer? Letter B, Graham-Leach-Bliley Act. All right, so the GLB Act, or sometimes they'll call it the GLBA, stands for Graham-Leach-Bliley. What is Graham-Leach-Bliley? Another way to put this in a very simplistic way is privacy. So this is the privacy law that you need to know for your exam. It is It is implemented by something called Regulation P. And isn't that easy? Reg P, remember P for privacy, right? P for privacy. So Gramm-Leach-Bliley is privacy law. Now, this privacy law has a couple of different pieces. Number one, it has privacy, being able to opt out of sharing your non-public private information, right? So, and then as you know, if you go to certain places, some of your private information that you have to sign this, this privacy notice, and then if you have an established relationship with them, in other words, if you're a customer versus a consumer, right? Like there's two different pathways here. If you're a customer of the firm, then annually you're going to have to get updated privacy notices. If you're a consumer and you're like a one-timer, then you just have to get that one instance of it. There's safeguarding rules inside of Gramm-Leach-Bliley, keeping people's private, non-public information safe while it's being utilized, keeping things under lock and key, pulverizing, shredding, destroying things, those kinds of things. With safeguarding rules, really, it's all about keeping the documentation safe and having a plan of action in play. It works hand in hand with the FACT Act, which is Regulation V, and FACT Act, its requirements also include shredding documents and pulverizing documents and destroying things digitally properly. And so these are some of the elements of the Gramm-Leach-Bliley Act, Regulation P. You're definitely going to want to know P for privacy, Gramm-Leach-Bliley, privacy law, privacy, and safeguarding rules. All right. That was the exam breakdown for today, March 5th, 2025. I hope you found some of these questions useful. Again, go back and replay some of the pieces. There's little bits and pieces that you want to know about these. What I like to do is go into some questions, and I like to analyze things and look at the answers and try to figure out why things are wrong. And we try to reinforce it. Also, keep in mind that we do the exam breakdown for my real estate professionals on Mondays. This coming Monday, we will be doing another segment where we're kind of working through the real estate licensing examinations for salespersons and brokers. Thank you very, very much for tuning in. Thank you all for those that have subscribed to our channel. Thank you for checking us out. Even if you haven't subscribed, please do if you haven't. But either way, if you're just kind of passing through and checking us out, if you're, thanks for the comments. Thanks for the feedback. Thanks for everybody sort of keying in. Thank you for those sharing with us that you're passing your examinations. Nothing pleases us more greatly. Thank you for the time that you shared with me. I hope it yields you success. Good luck with your studies and good luck on your tests. We will see you all in the next exam breakdown this coming Monday. Have a great weekend. We'll see you soon.